Welcome to Global Money Talk, brought to you by Sompro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining me today is Larry Raiman, CIO at LDR Capital Management. Larry, it's great to have you on the show again.
So nice seeing you again. Thank you for having me this morning.
Oh, it's lovely to have you. Well, one of the things we want to talk about today is the multifamily housing. And I realize that many of our viewers or people in the finance business, we hear about housing starts and they're always talking about single family, and multifamily barely gets a mention. So I don't know very much about it, and I think our viewers would love to hear about it. So can you just describe the multifamily market and just give us an idea of the scale of how big it is?
Sure, by all means, and thanks for having me this morning. The multifamily housing market is large. It's one of the most important commercial real estate property sectors. As well, it's vital to our society. Our country needs housing, it needs affordable housing, and the rental marketplace provides one of those alternatives. To put it in the scale of things, the apartment marketplace is close to $1 trillion of asset value. 100 million people rent apartments, 44 million households. That's approximately a third of our country renting apartments. When you think about the apartment market, you think about high-rise apartment buildings here in New York City and some urban areas. You also think about garden-style apartments in suburban markets. You think about 2 and 3 unit structures all across the country. So the spectrum of apartment houses are large and varied. You think about, as well, you think about 2-unit apartment complexes to 500-unit complexes with full amenities. So it spans the spectrum of rental housing all across the board. Suffice it to say, it's a very large marketplace, hundreds of billions of dollars, if not $1 trillion of assets, a third of our country renting apartments, and very vital to our country.
So who are the owners of these multifamily units? Are they your regular people? Are they large corporations, large landlords? Who owns these multifamily units?
Yes, yes, and yes. It's all of the above. It is the largest institutions out there, insurance companies, university endowments, the largest private equity firms, specialized private equity firms focused on the apartment market. Then you have family offices all the way through the spectrum to individual investors wanting to buy an apartment and renting it out. You've got generational owners, families that own apartments for generations and pass them down year after year, generation after generation. So the ownership structure crosses the landscape of investors all across our country, all across our capital markets.
Now, who are the primary renters? Do they change over time? Do renters ultimately become buyers of homes? What kind of patterns do you notice, and is that changing at all in today's landscape of unusual landscape of high interest rates and high home prices?
100%. Very important question. So let's go to the numbers. The average owner of a home is 55 years old. 55 years old. The average first-time home buyer is 33 years old. So what you find is that people start buying homes when they're 33, but not really. It gets them into the late 30s, early 40s, sometimes early 50s before they're buying homes. So on the other side, the biggest cohort of renters are below 30, below 35. The majority of folks who are in their early 30s and certainly late 20s are renting. So what does that mean? You find the dynamic where you have younger folks just starting out will likely rent. They may buy a home when they're 30, but they're starting to buy homes in their late 30s to early 40s, maybe even moving into their 50s. And that's the kind of the demographic change. And then it goes to, what's the decision point? When I should rent, when I should buy. And there's a lot of discussion about the affordability rates, and particularly interest rates, and home prices have risen. Let me give you some numbers. The decision point for either renting or buying If you rent an apartment, you pay your rent every month, you pay your rent for the year, poof, that money's gone. That's your cost of occupying that rental apartment. What's the cost of owning a home? The cost of owning a home has different costs to it. You've got real estate taxes, you've got property maintenance, you've got insurance, and then you got to buy the home, which means there's interest on your mortgage and there's an opportunity cost to the down deposit you place on that home. When you wrap all of those costs to home ownership together, it approximates 10, 11, 12% depending upon interest rates. So you get some tax deductions for it. So let's put numbers to the page. Let's say you were thinking about either renting a home or buying a home. And let's say the home value was just rounded $1 million. The cost of owning that home would be probably around 10% or $100,000 a year. So then you say, well, maybe I'll rent it. Well, if my rent was less than $100,000, I'd be better off financially renting it. If it costs more than $100,000, I'd probably be better off financially owning it. Now, there's other non-financial factors, whether you'd want to rent or buy, life circumstances, but from a financial, purely rational economic perspective, the decision point comes down to which is more affordable, which is not, and most recently, with interest rates rising, with inflation, with the cost of homes rising, in 90% of the markets, it's actually cheaper to rent than it is to buy. So we've seen home ownership rates decline to a degree.
So you said rational, which is really interesting. We said, at the risk of sounding like economists here, right? Have over time, have Americans been generally rational in deciding to rent or buy, or those other factors that you mentioned come into play where they probably should be renting, but they buy, for the, they want to be a homeowner, they want to, not have to, have next door neighbors who complain about the piano or the kids shouting. Or have Americans been rational? Has that changed over time?
It definitely changes depending upon the economic time period we're in, the political climate we're in. By and large, yeah, we're not purely rational economic units. We're human beings, and we've got other influences that decide and help us make decisions upon whether we should rent or buy. By and large, the home ownership rates have been fairly sticky across this country at about 2/3, at about 66%. And that's been pretty stable across many, many decades. Now, right now, that decision is tipping its scales a little more towards rental rates. So we're seeing home ownership rates, particularly with the younger family units, not buy as much. So as an example, younger family units on average had been owning homes at about a 45% clip, renting at about 55%. That's now reduced to about 39%. So younger family units and individuals are choosing to, for whatever set of reasons, maybe financial, maybe non-financial, choosing to rent a little more prominently and a little with greater length.
Have you seen any? I think our total fertility rates in this country have declined a bit. Our population hasn't, because we actually have a lot of immigration, which I suppose in some ways, politics aside, is good news, because people want to come to this country because there's tremendous opportunity here. But with the fact that our total fertility rate, people are generally having fewer children. Do you sense that that's going to change the dynamics slowly but importantly over time? That maybe with a big family, you want a house, but with a smaller family, maybe a 2 or 3 bedroom apartment is enough. Do you sense any kind of change like that?
For sure, for sure. Demographics, migration, in-migration plays a very important role into the housing market. Be specific. The average apartment is about 1,100 square feet. Okay? Your average home would likely be more. So in the context of a lower fertility rate, you're absolutely right, Tai. The decision may be, you know what? I don't need all that square footage and have to put all that money into a new home. I can continue to rent for a little while longer, and we're definitely seeing that. So the context of fertility rates, in-migration, immigration patterns, immigration volumes play an important role in the overall housing market and how it lays out with regard to the apartment market as well as the home ownership market.
So with more and more people renting, it sounds like, and a trend that seems likely to continue, especially with demographics as you just mentioned, how are rental rates going in general? Nationally, I mean, certainly New York, I think it's a little maybe unusual than an unusual market. But how are rental rates? Are they going up substantially over the?
Very interesting. Mm-hmm. There's been a trend since the pandemic. Right out of the pandemic, people came out of their homes, got back to their jobs, changed their living situation. So in the early 21, 22, 23 period, rental rates were up 10 or 15%, oftentimes 20%. That's now coming back to 1 to 2 to 3% rent growth. Now, when you lift the hood up and you think about where rents are occurring and by whom, what you find is that people, when they're in an apartment, kind of want to stay there. They don't want to pick up their stuff and move across the street. They don't want to change their address, move all their things, so they're staying. So you're seeing rent increases by people who occupy homes and want to stay in those rent-occupied homes by an order of 1, 2, 3, or 4%. Where we're seeing rent declines are in new rental rate contracts where there's a vacant apartment and you have a new tenant. We saw just this past month in November, rates were down 1.1%. Rental rates were down 1.1% year over year in the month of November. They were down 0.7% month over month from October to November. So, and the reason is new construction starts, which we can talk about. So we've seen a lot of new construction, new deliveries on the market. So a new tenant can look at one corner or another and pick and choose between apartments. And whereas in the past, things were tight a couple years ago, now we're seeing rents come off a little bit and concessions. I'll give you 1 month free to join my apartment. That's starting to go up. So we're seeing a softening in the rental marketplace, which is actually good for inflationary conditions.
I do want to, excuse me, I do want to get to the building, but just a quick question. Is a decline month on month in rents unusual?
It usually is. Normally the rental rate market over the course of long periods of time, we've seen rental rates in line with inflation, up 2 to 3%. More normal conditions. Coming out of the pandemic was an atypical economic condition. We don't normally see rent declines. Only times we see rent declines are when we see big swaths of new apartment houses coming on the market and supply overwhelming demand, thereby depressing rent structures.
Fascinating. So I live in Westchester, and I know my train station is White Plains, and I have these monstrous buildings going up over the past several years. Beautiful, shiny apartment buildings near the train station. I like to think they're actually probably pretty expensive, but that's just my personal experience. But generally, has there been a lot of building overall of multifamily units?
There has been, but it varies by market. So let me be specific, if I may. Coming out of the pandemic, we saw close to 1 million apartment units being delivered, mostly in the South. So when you look at where apartments are being built, we're now seeing about 400,000 apartment unit starts. So back to more normal levels of about 1 to 2% of existing stock. So new construction nationwide is coming back to a more normal level of about 1 to 2% of stock, which is very good for our society. There's a but, and that is that new supply is concentrated. It's concentrated mostly in what we call the smile states, from the southeast to the southwest. That represents about, that's what we think of, and that's about half of the construction. So the other half, about 200,000 units, are being started in the northeast, White Plains as an example, through the Midwest, through the West Coast. So we've seen new construction starts very much in sync with where a lot of demographic growth has been occurring, which is in the South. Less so in more infilled, more hard-to-build markets in the Northeast and California.
And how are, I guess, in terms of valuations, are they, I guess you're building a lot, people are building a lot of these buildings because they think they can get the return that they're hoping for. Are they seeing that or not so much?
It's been a tricky time period for the last few years. Much like in broader commercial real estate, you've had building values for apartments decline on the order of 20 or 30%, maybe 10% if it's been a very good property. The reason is coming out of a period where we've had such short, low interest rates. You had apartment complexes trading for 3.5% cap rates, or cap rate being a cash flow return on cost. So you had 3.5 to 4 to 4.5% cap rates, fairly low yields on cost in the apartment market. With interest rates rising, now you're talking about cap rates of 5.5% in the marketplace. So oftentimes you're seeing property values decline by 10 or 20% as people need a higher return on cost because interest rates are higher and they could get it in tax-free treasury rates. So we have seen property values decline in the marketplace. They've stabilized of late, but we did see, again, 10 to 20 to 30% declines of asset values in the apartment market. That's despite having a very healthy operating environment for apartments. Rents doing fine, occupancies tight of 95%. So it hasn't been poor operating results that has caused a decline in property values. It's been higher interest rates.
So I just want to segue into the operating side of it. So you're saying that occupancy rates of 95%, which actually sounds very, very high to me, to my untrained ears. And have costs associated with running an apartment? That seems to be, how are those doing, those costs?
So costs have really trended like you would have expected. Coming out of the pandemic, costs were crazy. Raw material costs, labor costs, repair costs, service costs, all were up 5 to 10, if not more, percent year over year. They've been coming in as well. So now the costs for operations for staffing an apartment house, union cost, the raw material costs, all the labor costs and facility costs, they're now back to more of a 1 to 2 to 3% level. So what we have seen is a more normalization in the operating results of apartment operators. Rental rates slightly positive, right around 1 to 2%, mostly by people who are staying in their apartments, getting rent bumps from, and the associated costs to run those apartments also up 1 to 2 to 3%. So thankfully we're getting to a more normal environment, both from a cost side as well as a revenue side.
First of all, I'm a little surprised that the cap rates are actually quite relatively low. I mean, at 2 or 3%, and now it's 5 or 6%. You're almost, I could see what you're saying. I can buy treasury bills, or I can buy a stock that has clip dividends. So it's quite a bit of work for you. You would imagine you'd like a better return.
Yes.
One question I do have, and I see all these shiny new buildings come up, and the rental prices seem relatively high. How quickly do landlords or new landlords especially adjust their prices if they see demand falling short? Like, I've just spent X millions of dollars putting up these buildings, and I'm actually not getting a lot of people renting. Well, do they move relatively quickly?
Oh yeah, they can move very quickly. So a couple of things. One, moving rental rates. Generally, apartment leases are 1 year in length. So apartment landlords can move rents and mark them to market, if you will, over a very short period of time, 12 months or less. And if it's a vacant apartment, they can set the rent at any rate to equal street rents and in the prevailing marketplace. So landlords do have the ability to respond to market conditions in a pretty quick fashion. You mentioned one other thing. Cap rates are kind of low relative to the market for other assets. And now, there's a reason for that. And that is the funding sources to buy an apartment complex are different than almost any other asset class across the globe. There's something called government-sponsored entities, GSEs, Fannie Mae and Freddie Mac. You don't get a government-sponsored entity providing you or me capital to go buy a stock, to go buy a bond, to go buy a car. But you can get a government-sponsored entity to give you financing to buy an apartment building, to buy a house. That's because of the core nature, the vital nature of housing in our country, our government has decided it wants to subsidize the cost of housing, which is important. The way they have done it is to finance government-sponsored entities to provide with cheap capital in the marketplace to buy homes and to buy apartments. So part of the reason why apartment buildings, multifamily units are trading at lower cap rates is that the cost of capital to buy them is much lower. And I can get government-sponsored entity to provide me capital to buy an apartment house at a very low subsidized interest rate because they get capital low interest rate. That helps my economic return.
That's fascinating. So hang on, let's take an example here. If I wanted, let's say round numbers, right? I wanted to buy a 10-unit building, and for $2 million, I can go to the GSEs to get funding for that. I don't have to go to a bank and get a commercial mortgage?
Correct. Let's compare and contrast. We buy stock, and let's say we don't have available cash to buy the stock. You go on margin to buy the stock. A margin call would be 7 or 8% to buy stock today. If you're an individual investor and you can't get a government-sponsored entity to give you capital, borrowing rates are high single digits. But if you have the available criteria, and there are criteria to conform to a Fannie Mae or Freddie Mac mortgage, if you meet those criteria, you do get cheaper financing for that. So that provides the criteria for owners to conform, to have a conforming loan and get cheaper capital.
So, I mean, without going deep into the details, what kind of conforming what do you have to do to conform to be eligible for that?
Yeah, the type of property, the type of tenant, the loan to value. The agencies don't want to have default risk, so they want to have generally lower loans to value. They want to have better credit ratings. They want to have particular types of buildings. So there's a whole menu of criteria that you have to check every single box in order to have a conforming loan. It all goes across the board with regard to the tenancy, the tenant credit, the loan to value, the type of building. So it all goes into one big pool, and then you can get a loan.
Interesting. Well, I mean, I own a little bit of rental property, but it was never indicated to me that this kind of funding was available. They went to a commercial bank, and I got a loan from a commercial bank. I suppose maybe the fees that they get from the GSEs are a little lower than they get from commercial banks, and they don't offer you that option for a reason.
Yeah.
So really, like, you and I can go out and as long as we get the right kinds of properties and with the right characteristics, like you and I as individual citizens can actually get the GSEs to fund us?
It is available in the marketplace. Oftentimes what would happen is we're not going to call Fannie Mae or Freddie Mac to say, hey, can you give us a loan? So what happens is you could work with a bank who sees that they can sell that mortgage that they provided you into the GSEs, and they could get a subsidized rate because they know they're going to turn around and sell that mortgage into the agency marketplace. And you could take advantage of the lower cost capital in the agency marketplace indirectly through your lender.
Oh, so you would have to go through your lender?
Oftentimes, yes.
Basically. And what's the difference between the commercial mortgage you get from a bank and the GSEs, roughly?
So you could get a couple, 300-400 basis points lower cost of capital from a GSE than a long-term mortgage that is non-conforming, if you will, from a non-GSE lender.
Wow.
So it could be several hundred basis points.
That's not nothing.
No, it's not nothing, and really goes to the purpose of them, and that is to provide capital for the housing market and to hopefully pass through those lower costs to tenants, to have a lower cost of occupancy for our country, to subsidize the cost of housing. So that's the purpose of this process.
I see. So I do want to get in very shortly how people can invest in this, but I do want to go down one little rabbit hole since we are sitting in New York City. And what you said before about how landlords can always really change their rents really quickly to reflect changing conditions. Well, New York City, that seems to be difficult, at least in probably maybe 35% of the market is rent stabilized, and that creates some issues. Can you talk very briefly about the New York City landscape and where we stand with that in terms of being able to have new building to for all the people who want to move and live here?
Yeah, New York needs new housing. It needs new housing. There's been household growth and there's been migration to New York. We need new housing here in New York. So it's hard to build in New York, very difficult. You need approvals and everything. Now we need subsidized housing for people who need subsidized housing. So you mentioned rent-regulated apartment houses. So there is a cost benefit to making an apartment house rent-regulated, and that is you have to take a portion of the building to deliver to folks who are, let's say, have lower income levels. Well, in return, you get tax abatements. So the cost benefit of having that sort of project is you can help out society, help out folks who maybe need a subsidized housing, which is wonderful, and you can get a tax abatement for that. So the municipality, the New York City in particular, the broader 5 boroughs, trying to create housing, they will give tax abatements to new developments for conversions from office to residential or any other type of facility or land to a residential. They'll give you a tax abatement, and that is pay less tax than you normally would, but make sure you quarantine some of your units for folks who really need a subsidy. And then we'll give you a tax abatement. And that's happening today.
Well, just a sense of where rents are in New York City, it seems like it needs a lot more supply, and I'm not sure that it's because it's so hard that we're going to get enough supply. So the end game here is probably, might be difficult for people who want to live in New York City.
It is a tight market. And you could argue that while there's so much demographic growth in the South, the urban markets right now, because of the phenomenon you just mentioned in New York, is happening in other urban markets, are much tighter and generating better growth rates right now because there's been almost no supply or very little supply in these urban markets, hard to build markets. And when you have demand tightening it, that causes rents to increase more than they normally would. That's certainly more than in the South. So what we need is a release valve. We need more housing, which would mean there's now a big thrust by New York City to help landlords convert their formerly office buildings, underutilized office buildings, to residential. And there'll be some tax programs and abatements to enable landlords to spend the money and see an economic return to deliver new units in the market. It'll take some time. It's not an overnight process. It's going to take years to fix the undersupply of housing, particularly in a market like New York.
I do want to get to how do our viewers and individual investors, how do they, if they want to invest in the multifamily market, how do they do it? Where do they do it?
So there's really a couple of ways that you can invest in the multifamily market here in the United States. One is on the public side. There's the REITs, the REITs. We're an investor in the REIT space, and you could buy publicly traded REITs that focus in apartments. You can focus, whether it's in the Northeast, there are names that focus in the Northeast, Southeast, Southwest, so you can prioritize the apartment sector in the public marketplace, and then you could dive a little more deeply and have a regional focus with regard to your investment into particular names where they are residing across the country. So that's one alternative. Buy a public REIT focused in the apartment market and benefit from the traditions and the growth in that asset class over the course of time. The second is there's a plethora of private equity firms that have big initiatives in the multifamily space. The largest generalized private equity firms down to specialized multifamily focused private equity firms that you can invest with directly as a limited partner. They'll create a fund structure and go out on your behalf and buy the assets directly. So there's two ways to do it in a nutshell. By indirectly apartments, by buying a stock in a company that owns apartments, or become an LP investor, a limited partner investor, into a private equity fund that goes out and buy apartments directly. So there's multiple ways to have access to the apartment market.
So it sounds like one is public REIT that you can probably buy and sell relatively easily and is quite liquid, but the other one is perhaps less so. So would you get a lower return on REITs than as an LP with a private equity firm or something that's not listed?
Over time, they kind of trend together.
They do try to trend
They
together.
trend. You know, the public REITs give the ability of having corporate governance. These are public companies with boards of directors, filing requirements, reporting their results every quarter, doing conference calls, going out and meeting investors. So you have transparency and, as you said, Tai, liquidity in the public marketplace. In the private marketplace, you don't have that same liquidity. You don't have that same transparency. But what you do have is the ability for the operator to add more value. You're closer to the bricks and mortar. That generally private equity firms leverage twice the leverage factor of a public company. So in a bull marketplace, the leveraged direct investments into apartments will do well. So over time, the end of the day, they're going to generally have kind of the same IRR over the course of time for the investor, because the ultimate raw material to both of those entities are apartment houses, rental apartment houses, generating consistent growth for the investor. How that's portrayed, whether in a private structure or a public structure, in a private equity firm or a public REIT, eventually they're going to kind of even out and be normalized about the same return.
That's great. Well, thank you so much for coming on the show again today. Look forward to having you in the future when we can dive more deeply into real estate. Thank you so much.
Thank you.
And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us. We'll be back here tomorrow. Have a great day.